Good morning, everybody, and a very warm welcome to a part of our Expo programme. We traditionally have at the Expos, when we were working online, had the great benefit of getting a guest speaker to give us some really good insights on the economy. And that's tended to be on an international front and national front, and just gave us an overview of where we were all going. So I'm delighted this morning to welcome Vicky Pryce, who is the Chief Economic Advisor and Board Member at the Centre for Economics and Business Research. We've had a little conversation about what she's going to present. There's a lot of incredible information which we will go through. We are going to look at starting kind of from an international viewpoint and then work into the national viewpoint. It's quite interesting as we go through this journey that we are not alone on all the pressures which are going on. There are obviously areas which different countries and different areas are responding and how they're dealing with these challenges, but the issues of inflation and obviously the pressures from the war in Ukraine are bearing down on a lot of Europe. Nobody gets out of this without, we're all getting very much affected. So Vicky, welcome. Thank you so much for your time this morning. And do you want to get your slides available and we'll start this morning?
Thank you. Indeed. Thank you very much for inviting me to give this presentation and have a chat with you about it all. I'm going to share my screen with a bit of luck, and it may all work.
The joys of doing things online.
Indeed. So here we are. I hope you can see it okay.
That's great. Thank you, Vicky.
Thank you very much. Indeed, as you said, there is a lot going on internationally, and we're not alone in this. But it's worth bearing in mind and remembering really how we got here, because a lot of what's happening right now stems from that. Of course, we had COVID. We were recovering reasonably well from the financial crisis, and then COVID struck. And governments intervened very significantly to assist the economies across the world, because of course, everything stopped. The moment you have COVID restrictions, people can't move. You close down factories, you close down movement really in terms of transport, infrastructure. You can't access services face to face, where quite a lot of the economy inevitably suffers, and the various governments stepped in very significantly to ease some of those pressures that were felt in the economy. Not everything shut down, of course, because there was huge amount being spent on the health services, and in some public services that continued operating, of course. But it did require an immense amount of support from governments in terms of fiscal measures that were introduced all across the world. And what I'm showing here is the percentage of GDP that went back to the economies by governments borrowing that money and then having a series of stimulus measures in Europe and elsewhere. Quite a lot of those measures took the form of furlough schemes, which were very successful. We had that, of course, in the UK. In places like the US, they didn't do that at all. They just let everyone lose their jobs, whereas under the furlough scheme, you were still kept on payroll. And then gradually those jobs sort of recovered when the economy opened up. In the US, they just let everyone lose their job if they had to, and supported them with checks coming through the post a number of times, quite substantial checks coming through the post. And what you also saw was at the same time that unemployment benefits went up quite significantly. So it was almost worth staying at home and not working. So unemployment rose to over 14%, whereas it was kept relatively low in other places. That amount of extra stimulus, these figures show you what happened from the beginning of the pandemic in early 2020 up to the autumn of 2021. There was a lot more that happened afterwards, but that was already very substantial. This was all supported by the monetary authorities coming in and injecting huge amounts of liquidity in the markets. They did that by buying, particularly, not just assisting with quite a lot of cheap loans to businesses to keep them going, but also buying government bonds in the secondary market. So basically funding the government deficits that were developing at the time. And by doing that, they also kept interest rates low, long-term interest rates low, by keeping yields for bonds low as well, because that's the way that the market works. They are fixed interest bonds, but if you raise their prices by going out and buying them, then the yield on those bonds goes down significantly, hugely helpful for mortgages, for corporate borrowing, and so on. And they also, of course, reduced short-term interest rates as well. So overall, the sum of what was done was a cut in interest rates to record lows. We're just beginning to recover from that now, of course, with a reversal of this. Huge amount, as I mentioned, of quantitative easing, buying government bonds, and also some corporate bonds in the secondary market, helping the markets to continue to operate, financing the fiscal expansion. But of course, what also happened was that the central bank's balance sheets increased very significantly, and overall credit rose, whether it's public credit or private credit, rose at the fastest rate in 2020 for 50 years. So it did keep the economies going. But what it did, of course, with such low interest rates in particular, it helped increase asset prices and also really inequality, because those with assets, whether it was shares or property, did quite well. Those who relied on incomes did less well by comparison. So there is a bit of a concern about that aspect that needs to be looked at by public policy. But also what we've seen is that what was happening in one country, particularly in the US, mattered for everybody else, because obviously if there is faster growth in one area, it then translates into faster growth elsewhere, particularly if it comes from the US. And it also, of course, helped the financial markets operate throughout that period. But as I said, considerable amount of asset price increases took place. And this is just an example of what happened in the UK. Remember, of course, we also had great support from a cut in stamp duty, and that was helpful for house prices, still is, interestingly enough, even though that reduction is now gone. It has certainly led to huge appetite for house buying. It's varied from region to region, of course, in the UK, with London not doing quite so well, helped, of course, in that respect, by the fact that people were leaving the big cities, particularly London, because of COVID. So you can see here how fast house prices have been increasing in the UK and in various regions. This picture has been copied in loads of other countries. If you look at the US, since the beginning of the pandemic, house prices have gone up by 30%. On average, and in some places within the US, much faster than that. Well, it's just one example, of course, of what's been happening to inflation. There's underlying inflation, even before the war in Ukraine. And just to show you the differences that there are between the projections in 2021, the end of 2021, yes, of course, inflation was picking up. Yes, demand was increasing quite sharply. Yes, supply couldn't quite respond to that increase in demand as restrictions were lifted. And yes, there were blockages in ports already. And yes, there were concerns about inflation. And yes, one was looking at interest rate increases and reversing some of those very low, record low interest rates we had seen during the pandemic.
I think this is an amazing chart, I'm afraid. But for those who are a little bit myself trying to find where's the UK is about just above the halfway line. There it is. There's the UK there.
Absolutely.
And this is, I think this is just an astonishing chart to just say how we are not alone. Everybody in some areas, certainly the Slovak countries and obviously closer to Russia, the knock-on is immense. It's quite eye-watering seeing this.
Indeed, it's sort of doubling on average. So this is the war. And the interesting thing is when the OECD produced, the Organization for Economic Cooperation and Development, produced a forecast just now in June, a few days ago, really, they put a headline for the overall sort of section that they were writing, which was the cost or the price of war. That's what they called it, the price of war, of the war. if I remember correctly. So the entire, therefore, sort of emphasis of their review of what was happening was because of the war in Ukraine, and what it has done to prices generally. So the inflation outlook has changed very considerably. Until then, the expectation was that this was transitory, that all these things that I mentioned that were already happening with supply constraints and so on were going to be resolved pretty quickly. And central banks, therefore, were pretty sort of sanguine about what's going to go on in the future. In other words, they expected prices to stabilize. And once prices stabilize, even if they stay at high levels, then inflation drops very significantly. Or you could, in fact, go back to deflation, which is what we had during COVID. And that has been the reason why central banks didn't react to any significant extent, despite the fact that a lot of those price increases were already touching on or expectations for 2022, touching on their targets, which is 2%, and in some cases exceeding them. But they thought it was all going to come back to normality pretty soon. So that's where we were. And of course, you can see quite clearly the implications of the rise in food and energy prices. And those have been the main components of the increase that we have seen in projections for 2022. And in fact, the reality already for 2022 for many of us and for many countries. There was deflation, as I mentioned, in parts of 2020 in particular, when, if you remember, the price of oil was at minus $37 a barrel. Well, we are at 120 now, quite a substantial increase, of course, and that has made a big, big difference to everything, including, of course, the prices we pay at the pumps right now. And that increase in inflation has been widespread. Interestingly enough, because it is a phenomenon which is affecting us all, it's an external phenomenon which has hit inflation expectations everywhere. It's almost similar in terms of the increases that we're experiencing or have experienced, whether you're in an advanced economy or whether you are in an emerging country or developing country. But having said all that, and before we get too depressed about this, I mean, first of all, of course, if you look at some of the forecasts, they'd still expect inflation to come down pretty, solidly over the next couple of years, except happening a bit later than was originally anticipated. But also it is true that in real terms, oil prices are not as high as they were when we're having various crises. So if you look at where we were in 1980, or if you look at where we were before the financial crisis, oil prices now are in real terms still below that, which is a good thing. But unfortunately, given that we now have loads and loads of independent monetary authorities, which are looking at keeping inflation the target of around 2%, mostly, what we're seeing is that we're way above that target. And therefore, the move already to change interest rates and move them up has begun, and is beginning in earnest, certainly in the US and the UK. We've seen already, of course, increases in places like Australia and Canada, and we're likely to see increases also in Europe for the European Central Bank starting in July. All this combined, of course, means that the economies have slowed down. This is a developed economies Purchasing Managers Index. The way to read this slightly complicated chart is to look at this red line, which is 50, which is the Purchasing Managers Index. If the index goes to below 50, then that's a recession. If it's above, it means you've got an expansion. What you see here is that you still have an expansion. That's the orange line, which is the current figures. If you ask firms where they are, you see that there has been a bit of an increase in output on a monthly basis at various stages, coming down a little bit in terms of its intensity, but still rising, even though it may have fallen. That's only the rate of increase that's fallen. So we're still at positive territory for current output. The green one is future output. You ask firms where they think they're going to be in a few months' time. And as you can see, I mean, firms tend to be slightly optimistic about the future. So they're looking ahead and saying, yes, things will be fine, keeping fingers crossed. They had underestimated, of course, the drop that happened in 2020. Everybody had underestimated it. Then, of course, remember, we had a few false starts with the Omicron variable and more lockdowns. We've got lockdowns right now still in China, so we're not over it by any stretch of the imagination. But that's basically where we are, a slowdown in growth and concern about where we might go from here. If you look closer to home and you look at Europe, we're still depending quite significantly on trade with Europe right now, despite what's been happening with Brexit. It's still a very important trading partner for us. Sentiment there has also suffered, and the consumer is seriously changing their habits. And also, of course, in terms of longer term interest rates, the market is beginning to worry. What we have here is the interest rate forecast over the next year and a bit that the OECD has put together for 10-year bonds. That's the yields, 10-year bonds. Perhaps those of you can see what was happening earlier. Bonds yields were negative for a while. I mean, Germany has been able to borrow at negative rates for quite some time. That's beginning to change, of course, now. The markets are much more aware that there is going to be an increase in inflation. They also know that interest rates are going up generally. So the expectation is that this will intensify. The problem is, of course, that this is a region with lots of divergent economies, some with quite high debts. And what we've seen is that the spread of yields has already increased very significantly. So Italy, for example, is now borrowing a lot more expensively than Germany is doing. And so is Greece, which is the place I come from originally. But even then, the question is, should we get terribly depressed? Any change in direction makes a difference, of course. But in real terms, again, just looking at the US and the UK have similar inflation rates right now, similar interest rates. But in real terms, we're still talking about very negative interest rates. And if you look back, you can see there were loads of periods before this one now when interest rates are considerably higher in real terms. So, as I mentioned earlier, oil prices low in real terms by comparison to before, and interest rates low in real terms by comparison to before. But of course, oil prices have risen very significantly. So this change makes a huge difference and push the inflation up. And of course, the change in interest rates matters too. So the result of all those factors is that annual growth projections have also been reduced very significantly. Remember, on the inflation front, everything was moving to the right. On the economic front, everything is moving to the left, more or less, with the exception of commodity exporting countries, particularly oil exporting countries or some food exporting countries that are doing better than perhaps had been anticipated. But again, how long that will last is a question mark. Food crisis may last for longer than an energy crisis, but so much depends on how long the war in Ukraine lasts as well. So what about the UK? Let's look at that a little bit more. The UK was doing okay. I think by the end of 2021, it was something like 1.3% above pre-pandemic levels. And lots of regions were sharing in the growth. That was in Q4, a growth of 1% in GDP in the UK. In the quarter, of course, much higher year on year. We grew by something like 7.4%. In 2021, after a drop of nearly 10% in 2020. Regions were doing okay. Yes, not all of them were hitting the average of the UK, but you can see that there was certainly in the Southwest, East Midlands, East of England, and London, and up to a point, the Southeast one was doing okay. In the other places, slightly less, but still positive growth overall. Well, this whole path has now changed. The interesting thing is to look at where we were forecasting we might be in the UK economy in 2019 when no COVID and no war in the Ukraine. And you can see this blue line, which is the actual, and then the up to then, and then the dotted line, which takes us to where we are now, more or less. This is where we would have been. That didn't quite happen. Already by the end of January 2022, 2020, we're beginning to worry about growth, which is a green line, but nobody expected that it was going to be such a sharp downturn as in fact materialized. So here we are. The pink line shows quite clearly the drop in GDP that we have experienced, and that if you look at the gap, then it's a very significant gap. And given that now in 2022, after the recovery in 2021, we're talking about very low growth ahead, then that gap gets bigger. What we call in economics, this type of gap is the scouring effect. Are we going to be scarred by this forever? Are we ever going to be able to return to and capture all this loss? In order to do that, you need many years of above trend growth. You need to be growing at much, much faster than what this little dotted line shows you. Well, we're not actually likely to get there. And as you may recall, just recently, the Organization for Economic Cooperation and Development, in its forecasts in June, also said that the UK was going to see the slowest growth in 2023. So if we look further to the right, in the G20, apart from Russia, which is quite a shock, of course, to the system. Well, again, let's think about something more positive. Vacancies are at a record high. We know that. One of the reasons, of course, is that quite a lot of people have withdrawn from the market, and we can't fill those jobs because they are doing different things right now. Look at the airport and airline sector and the problems they're having with recruiting right now. We have an unemployment rate which is even below where it was pre-pandemic, so we've done very well in that respect. But there are serious issues. Yes?
Yeah, sorry, we were talking about this just a little bit before, but I noticed that there was 450,000 that have left the workforce since 2019. You mentioned that there's a lot of movement with students. There's obviously a lot of movement with people who have decided to take early retirement.
Yes.
Can you just clarify that a little bit about the students element?
Yes, well, you are considered to be inactive in the labour market if you're not looking for a job at all. So you're not even looking to do 1 hour or anything, part-time, anything at all. That is paid. Students, of course, normally don't look for jobs, except possibly during vacation time. So if you find, as we did during the COVID period, that people decided, since the jobs weren't around, to maybe do more studying or stay a little bit longer. And in some cases, of course, the courses were extended because people weren't able to take their exams at various stages and so on. So what you find is that all these people count as inactive. Plus, you had lots of people departing from the labour market, quite a lot of women, for example, and you had, of course, lots of EU citizens who went back and didn't come back.
Yeah.
So there is a lot of that, which means that there are problems with those vacancies, that they cannot get filled as easily as was the case before, with the result that, of course, in a number of sectors, we have had extra visas granted to bring in people from the EU and elsewhere to fill those occupations where there are big shortages at present.
Thank you.
That's what's been happening. Of course, all these input costs that I mentioned, whether it's energy, but also, up to a point, shortages of labor, and all these issues to do with supply chains, which have been worse in the UK because of Brexit, have meant that inflation, of course, has picked up. And add to this the Ukraine war, and you end up with the type of inflation which is the highest since 1984 and is likely to get even higher. The Bank of England expects that inflation will peak at over 10% later this year. Now, we have to keep our fingers crossed and hope that that is indeed the peak. And within that, of course, it is to a considerable extent energy that is to blame. Yes, now food prices are beginning to go up quite significantly, and that's another worry. But you can see from this that inflation excluding energy is considerably lower. That's the orange line. Inflation with energy is considerably higher. If you look at the US, if you look at Europe, you also find that it is really mostly energy and food prices that are responsible for the increases that we have seen. And there are, in fact, some amazing figures again there. So if you look at German producer prices, they've been going up by over 30% year on year. Ours, amazingly, a bit less, by just 14%. I think it's the composition of the sectors in Germany, with a lot of manufacturing, which has been relying on all sorts of inputs from elsewhere, plus, of course, much more energy intensive sectors as a result, whereas we are more of a service economy. So all these issues are really important there, and companies are finding it quite difficult to deal with that inevitably.
I did note that there was a figure, again, I read over the weekend, was actually your previous slide, it says from 1984. Apparently back in 1980, the inflation, because of, and we've talked about sort of the grim 70s, by 1980, our inflation was up to 18%. So we have been in periods of really high inflation. But as you said, it's about this scouring element, is how deeply is it going to take us to get out of these periods?
Well, the way we did see inflation come down, and after the 84 period, it came down quite significantly, is because, of course, there have been recessions. So this high inflation has been followed by reaction, of course, from governments, and then recession. So the question is, are we going to have recession now? Yeah. Or are we going to have just stagflation, which is what most people are talking about, which is high inflation but very little growth, rather than actual recession. Dropping, yeah. Loads of people think that actually we're going to have not just recession but depression, because in order to bring inflation down, you'd have to really raise interest rates very significantly, and that would just stop the economies, in their tracks, basically. But because there's so many unknowns, inflation may indeed come down by itself very fast if prices of energy and food stabilize. And that's the big unknown at present. But the problem, of course, is that in the meantime, wages are not able to rise in line with inflation overall. For most people, yes, if you add bonuses, you're just about there. But if you look at real pay, which is the dotted darker line, we're still really talking about real pay going up very little. In fact, if anything, actually looking almost negative at times. And that's a real concern about the purchasing power of individuals, and hence why consumer confidence is in fact falling. And you can do various things if there is quite a lot of trade union power, and we see actually in the UK that trade union power exists still in public services area, as we are about to see with the strikes for train drivers and others. But actually trade union power generally has been declining in the UK, but it's been declining everywhere. And it's interesting looking at previous periods of, the winter of discontent we had, for example, in the late 70s. It all started with strikes in the private sector, which were then followed by strikes in the public sector. Here, it seems to be starting the other way around and may spread to the private sector. But it's a slightly different environment, and it's not just us. This is the case everywhere, as you can see, very substantial drop in union representation across. But given that wages are not rising in line with inflation, unless you include bonuses, which not everyone gets, of course, and where you see the real inequality that's developed. So financial sector, business services getting above inflation increases, loads of people in the rest of the economy getting below inflationary wage increases, and of course the public sector even less, and hence the problems that we're encountering there. So consumer confidence is falling because of this cost of living crisis. It fell to record low levels within the last month that it was recorded. And obviously if confidence is low, you don't go out to spend. You look at different ways of adjusting your budget somehow. So that's one factor. The other one that we need to worry about and wonder therefore whether we will end up with either stagflation or recession for a while is what happens to investment. Business investment had been recovering after the financial crisis. Then, of course, we had Brexit, the vote, and then it sort of didn't grow at all over a period. And then it dropped very substantially at the time of COVID. It's been recovering a bit, but it's still overall, if you look at business investment, about 9% below pre-pandemic levels. So what's been happening in the economy is that, those worries have been, if you like, voiced increasingly by the likes of the CBI, the Confederation of British Industry, because what we've seen is, although investment overall has done okay, and it's about 3.4% higher than pre-COVID, it is mainly because of public sector investment, government investment, and house building. So that isn't the type of investment which is particularly productive, which is really what we need, which is a business investment, which is a thing that actually keeps the economy going and ensures that productivity goes up. And what we've seen is that transport equipment, investment in transport equipment in other buildings and structures, so not houses, have been among the weakest areas, and they've been bringing business investment down. So it's not surprising, therefore, that the CBI plan, I say it's reported in the Sunday Times, of course, the CBI has produced its own, if you like, press release on this and publication. So I encourage you all to look at it in more detail, but these are the headline points. They wanted the super deduction that, as you know, was introduced during COVID, which is running out next year, to become permanent. So it's a big capital allowance that you get for investment, which is good news and should be continued. And they claim that this has helped business investment a little bit so far. So they want that to become permanent. They want faster approval for offshore wind by the government and local authorities. They also want to have a new, I've put a question mark after the post-war. We don't know when we're going to get to that position, frankly. So basically we need it now. A recovery loan scheme, which takes over from what we had during COVID. In the immediate future, they want a deal with the unions so that the summer strikes don't come. I have to say that my own firm has calculated the cost of the strikes. It's just under 100 million for the time being, if they take place as planned. Then, of course, in terms of doing something about those vacancies that we discussed before, regular updates to know what's happening in various sectors, where are those occupations, where there are problems, what can we do about them, maybe having new visas issued and quickly so that those problems are faced, because otherwise input costs of businesses go up very significantly. And of course, big firms can deal with a number of these things, smaller firms cannot. So real issue about SMEs. Then, what can you do in terms of having a bit of extra cash? And they want to redirect the apprenticeship levy to more important short-term issues. But they're also worried about the protocol and what this might mean in terms of relations with the EU, which, of course, we all need to be on the lookout for, because, of course, a new bill has come forward, and it will have all sorts of suggestions on how to override some of those protocol issues. So, but what
I think the key thing, I think one of the things I'm conscious of with time here a little bit, but I think one of the key things which you mentioned just about there is the speed of this, is a sense that we're playing catch up already. And I think some of this really does need to play out much quicker, because I do think by September, October, there's going to be quite a pinch point for a lot of businesses, and I think it's just the speed of these things need to be done.
Well, and also some sort of consistency in terms of approach. I mean, you've seen, of course, the airline sector saying that they, of course, were left to themselves after the furlough scheme finished. And there were still restrictions for quite a few months afterwards. One of the reasons why we're having this sort of chaos, if you like, in airports and airlines. But of course, there is the other concern, which is that COVID cases are rising again. We may find ourselves in a position in the autumn where there are more restrictions coming again. So a lot of uncertainty, and therefore dealing with some of these issues now to at least set the economy on a path of,
yeah. I was going to suggest, as I say, conscious of time for you. Can we just go to those charts regarding the Brexit, just in terms of the trades and how that's looking? Can we do that?
Absolutely, but of course reminding everyone that we did see this reduction in GDP in April of 0.3%, and that's a real issue, and that is why the points you were just making are absolutely valid, in the sense of needing very quick reaction to things that are happening now, which might therefore lead to businesses suffering unnecessarily, if you like, in the short to medium term, and then being hit by other things later that they cannot cope with. And just to remind everyone, of course, that this is the forecast by the Bank of England, hardly any growth coming in the next year or two, in fact, which cannot be a very healthy environment to operate in. And yes, indeed, I mean, there's worry about Brexit as well, and how that might play out over the longer term. We've already seen that trade, certainly with Europe, has slowed down, but what we're also seeing is that overall, partly because of that trade with Europe slowing down, and after all, we were depending on Europe, something like 45% of our trade. Lots of other countries, as things recovered, as world trade picked up, were able to increase their exports quite significantly. So if you look at the left part of the slide, you've seen that the UK, with a few sort of ups and downs, a bit of volatility there, actually overall has not been able to recover the trade flows that they had before. So that's a real issue for the future as well, because the more you trade, the more productive you are. The more competition there is in what you're doing, the more you innovate, and so on. And what the OBR feels, which is the Office for Budget Responsibility, which has produced some of those figures in their reports recently that accompanied first the budget and then the spring statement, is that the trade intensity of the UK is going down, and all that's pretty bad for productivity and growth. So already the expectation was that not only are we and lots of other countries going to have lost permanently something like 2% of our GDP because of COVID, which was, if you remember the slide I showed you earlier, with a gap between where we would have been and where we are likely to be because of COVID. And then, of course, you add the Ukraine as well. But also, in addition, we would lose something like 4% of our GDP permanently because of Brexit. So indeed, something needs to give. And quite a lot of the suggestions made by business organizations now are how to make up for it, really, and ensure that we get back to some normal trend growth again.
Do you see this as, just finally wrapping up, do you see this particular area, what kind of time scale do you think it's going to take to actually get this back up to a more palatable level, do you think?
Well, I'm particularly worried about things getting worse in the short term, and that is because of what we discussed before. It's the concerns about the Northern Ireland Protocol, which works in a certain way now, as we know, as I'm showing in this slide. Now, if we try to override the protocol unilaterally, and the Europeans react, then, if anything, the trade picture I showed before is going to get worse. And indeed, it might be worth showing this final slide, which shows that our direction of trade has changed very significantly. And the types of relationships we had before with our European suppliers and various countries are now changing very significantly. So if you just focus on the left bit of this slide, which is on the good side, what we're seeing is that imports from non-EU countries have risen very significantly. Imports from EU countries have not really. So this is the green line here, the green. So we're just not re-establishing those relationships fast at all, or at any rate at all. And that's a worry for the longer term and probably justifies some of the OBR's pessimism about growth in the future.
But the one thing which we discussed before is that actually our financial services, we have always counted on our financial services as being strong and healthy and still respected in Europe. You were saying it still claims that it has a #1 status?
Yes, absolutely. And that is shown really in the services slide, on the right-hand side of this. Yes, I mean, services have stayed quite high, which is very good news. There have been lots of concerns that this, particularly the financial services, were going to suffer as a result of Brexit. So far, so good, although there are warning signs ahead for that one too.
Thank you. Vicky, it's thank you so much. There's a tremendous amount of content there and a lot of sobering thought. I don't think there's any way that anybody is foolish enough to kind of massage and say, oh, it's all going to be, we're going to be fine in 6 months' time. Are there, just finally, are there any kind of green shoots of areas which you'd say, do you know, we should be positive about these areas? Is there anything which you could sort of signpost going forward?
I think the interesting development, of course, recently has been this search for self-sufficiency in energy. There's a little bit in food as well, with a new food strategy, which not everyone is completely enamored with. But certainly on the energy front and the innovation front, there seems to be quite a lot of push to improve our ability to innovate, and the money perhaps that goes into innovation as well. So the government seems to be determined to do something about this. And there is quite a lot of rethinking about energy self-sufficiency. So obviously areas, you know, oil and gas are still going to be doing okay for a while. Yes, of course, companies may get windfall taxes imposed on them, but as a sector, it's going to be receiving quite a lot of attention. But also this entire area of environmental investment, because if anything, to achieve the self-sufficiency we want to have, or at least improving it in energy, will require an awful lot of investment in renewables. So I think the government is likely to get quite involved in all this. So for the longer term, what we'll see is that there is a lot of attention in some sectors. In the shorter term, thinking about green shoots, it's much will depend on what the government does in terms of redirecting some of the taxes it collects, or even cutting some taxes in the short to medium term to encourage the economy. So there could be a bit more of that. So I think the idea of just reducing the deficit for the time being seems to be thrown out of the window. Already the announced changes since the March statement, really, or including the March statement, are costing the government about 37 billion extra than what it thought it was going to be spending. So I think we can get a little bit of help that will come in various areas and possibly various sectors. So there's probably a bit of rethinking taking place right now. So I think some of the issues we raise now are going to lead to some changes in policy as well. So maybe that's a positive thing, and let's see how it all pans out.
Thank you, Vicky. I really appreciate your time and for your clarity with this. Some really, really interesting details you've supplied us. As I've said at the very beginning, this is a point in time. This is June the 13th. So we have to always bear this in mind when you are watching this. But thank you again, Vicky. I hope we can speak again in some time soon. I hope everybody else enjoys listening to what we've been saying, or getting some good information, which is very precious to get these days. Thank you so much, Vicky. Look after yourself. We'll speak soon. Thank you.
Thank you very much.
Thank you. Bye-bye.
Bye-bye.